Greetings, 'tis Woden's Day once more, and let's go to the United States of America. Housing starts and completions, 1 unit structures. 1 unit structure, I presume, is what we would normally term a house. So, building houses in the United States of America, in the good old days of 2005 and 6, they were building 1.5 million. At the moment they're building 400,000. And as long as that remains the case, the American economy is going absolutely nowhere. Next calculated risk chart, year-over-year change in private and public payroll employment. An interesting chart. Going back to 1980, you can see the two were really round-awound each other in the positive territory, around 2%. But in the recession, the private employment went tumbling down, and now it's come back. But don't forget, when you come back, it's a year-over-year thing, and you're only beating the year before, which, if it was bad, it doesn't take much beating. And if it was good, the chances are you're likely to fall. So all these lines will always have the tendency to go in the opposite direction to where it was going. Yeah? Does that make sense? I hope so. But we can see, since the recession, the private employment has come back and now is running at 2%, but with public employment down at -1%, just what everyone would want. And there will be people getting all hard and wet out there that as long as this continues, this will continue, as in, let's have less public employment and this will lead to more private employment. Oh, no, it won't. Moving on. Labour and dividend income. This is from the CFR, Council of Foreign Relations. The nice people there. Okay, the big chart on the left, the blue, is personal dividend income. Personal, that means you and me, or anybody that owns shares, stocks, equity, and gets dividends from them. The company pays out dividends. And that since 1979 has been on the 45 degrees, bottom left, top right, up and up. Conversely, Labour's share of income, in other words, how much do the Labour part of the company get out of the overall profits, and that percentage since 1979 has been on the 45 degrees, top left, bottom right, on its way down and down. And not just that, really, since the year 2000, it's been on the falling out of bed. It's really going down and down. More dividends for the owners of stocks and less money for the workers. So say the Council of Foreign Relations. Now, in the bottom right there, we have a little easy chart in colours of who owns these stocks, shares, equities, therefore who gets the dividends, divided up into the annual income percentiles. And no surprise, the rich people own the stocks, shares, equity, and therefore get the dividends. And it steps down and down and down to the workers at the bottom who do not own these stocks, shares, dividends, equity. They do the work, and referencing back to the big chart, they do the work and are getting less and less of the profits from that work. So say the Council of Foreign Relations. This is classic Marxian, as in Karl Marx, economics, but I doubt if anybody would dare to use those words in the Council of Foreign Relations. Moving on to Bloomberg. Federal Reserve stress tests make us all Muppets, by Simon Johnson, who must have just finished a book or something. I think he has, actually, because his articles have been absolutely rubbish for the last 6 months, presumably while he's been writing his book. Now he's finished, he's really on form. There was disheartening news last week regarding the way the US financial system operates. I'm not referring to the opinion piece by a departing Goldman Sachs Group Inc. employee who suggested that the company has little respect for its customers, nothing we didn't know, and anybody that didn't know it that deals with Goldman Sachs shouldn't have been dealing with Goldman Sachs. But it wasn't that was disheartening. From the body of the article we get under the heading of economic uncertainty. But there's a problem, and it's not a small one. If you buy the Fed's view of what is likely to constitute stress, there is some justification for its action, in other words, letting the banks free to pay more dividends. Even then, you should ask the question Adnat Admati at Stanford has been pressing. Why would we let banks reduce their capital in the face of so much financial and economic uncertainty in the world? If you leave shareholder equity on the balance sheet, it still belongs to the shareholders. Yeah, that's the capital, that's the equity, leave it on the balance sheet. The company is still owned by the shareholders. So they're not losing anything, that's just not taking it out immediately. Let it stay there as loss-absorbing capital in case the world turns nasty again, says Anat. Reducing bank capital, according to Admati and her colleagues, I think it's just her actually, doesn't help the economy. Bankers like lower capital levels because their pay is based on return on capital when it's unadjusted for risk. Shareholders are willing to go along either because they don't understand the risks of thinly capitalized and therefore highly leveraged businesses, or they expect to share in the downside protection that will be provided by the government. And this is just, if you didn't understand it, you should have done. Basically, you should have done, because this is just what banking does. It's basically making the money, dividing it up quickly, getting it out of there, but knowing that if the shit hits the fan, the government will come in and bail them out again. Admati has had the wonderful way of attacking the capital reserve problem, because the questions normally revolve around should it be somewhere between 6 and 10%, and they normally oscillate around 8%. Admati says, well, let's get this argument really sensibly on the table and say, why not 50%? You know, trying to draw that argument really out and have a real discussion about it, because there is no reason on earth why it should be oscillating around 8%, except that's the sort of number bankers would like it to oscillate around. Let's move on to number 6, the Board of Governors of the Federal Reserve System. Bless their little cotton socks. And a press release from March 20th, the Federal Reserve Bank's 2011 net income of $77.4 billion was derived primarily from $83.6 billion in interest income on securities acquired through open market operations. Easy money, easy money. Note on the bottom, the reserve banks provided for payments of $75.4 billion of their 2011 net income to the United States Treasury. At least someone's making the money and giving it to the United States Treasury. Fed Kochilakota. Fed may need to hike as soon as 2012. With inflation on an upswing, ? By Mystic, and the labour market doing better than expected, again, half a question mark, the United States Federal Reserve should not ease policy any further and may need to start raising interest rates as soon as this year, a top Fed official said on Tuesday. I don't think so. Over at the Federal Reserve Bank of Cleveland, because they do the real interest rates. Yeah, it's Cleveland. The 10-year expected inflation and inflation risk premium. This is for investment, not that we do investments. This is the important gear. This is what you need to know. Going back to 1982, 10-year expected inflation risks. I won't go into how it's calculated. Back in 82, they saw the future as 6% inflation, and going forward and forward, they were always projecting inflation to be less and less and less and less, and all through this recession, inflation to be less and less. This is the prevailing market view, and there is no need at all for the Fed to hike rates or to tighten at all. And I see no reason at all why that should start going up again. Right, Captured Europe. This is a Project Syndicate article by Simon Johnson and Darren Acemoglu of Why Empires Fail fame, new book out, which is causing such a lot of stir in the blogosphere at the moment. Darren Acemoglu. Okay, Washington, D.C., Europe. Europe's policy elite, the people who call the shots at the national and Eurozone level, are in serious trouble. They have mismanaged their way into a deep crisis, betraying all of the lofty promises of unity and prosperity issued when the euro was created. The currency union may survive, but for millions of people, the euro has already failed its mission of sustaining growth and ensuring stability. How did this happen? And it goes into it. It's a reasonable article. The Greek, Portuguese, Irish and Italian economies are reeling under fiscal austerity, with budget cuts and higher taxes as far as the eye can see. This policy mix will slow their growth and that of the rest of Europe. And this is the basic picture across the world now. Blah, blah, and more blah, at best. Bless Christine Lagarde going to tell the Chinese what to do. China yuan could be reserve currency with reform. China, their currency, the yuan, could be the reserve currency if they reform. And basically this is, please reform. It's got absolutely nothing to do with one day you'll be the reserve currency, because we will not see that in our lifetimes. Beijing, China's yuan could become a reserve currency in future if the country undertakes further economic reform, IMF Managing Director Christine Lagarde said in a speech on Sunday. The IMF chief, speaking to a gathering of leading Chinese policymakers and global business leaders, added that China needed a roadmap for a stronger, more flexible exchange rate system. Basically, she's trying to tell the Chinese what to do. And she should know better, because the last thing you should do with the Chinese is tell them what to do. They do not like it. Number 11, China halts 10 more Airbus orders. China has suspended the purchase of 10 more Airbus jets. Two people familiar with the matter said on Thursday the move to delay the purchase of extra A330 planes brings to $14 billion the value of European aircrafts caught up in the tensions over EU emissions trading scheme. And just to show one way of showing across the Eurozone how they're doing, this is new passenger car registrations over the last 12 months. But really it's been since the summer of last year, it's really been on the down and down. It was having a bit of revival, summer sales at plus 7% coming from a low base. Ever since then it's been on the down and down, and is down 10% for car registrations. And again, how do we expect Greece, Portugal, Spain, Ireland, Italy to be buying cars, especially made by companies in Germany? No, we don't. And this is why it's no good to crush some people and expect that you're going to be all right. The world is a connected place with great amount of knock-ons, and there are just too many huge countries running blah policies at the moment, so the world is going to be blah. Blah blah, bye.